Okay, I think we can start. Again, thanks very much for actually, tuning in today. Today we wanted to look at a little bit of a trading strategy. I think we've been talking about a lot about the entry position, entry point, where to enter, how to analyze, in a market. Please remember as well that we all do these things just to help each other, so that everyone can be able to get in the market and to start making the profit on their own. It's all about helping, assisting each other, and make sure that we capitalize and we making a good profit for ourselves. So the little things that I wanted to share today, it's about some of the few advanced trading strategies that you can find in the market, right? We talked about last week, as I said, about the entry point. We know for sure right now, maybe a little bit of information we understand about how support and the resistance work, and now when they say we have advanced trading strategy, because most of you guys, you might find your mentors are telling you that, I have advanced trading strategy and I can help you with this advanced trading strategy, and I want you to give me this amount of money for me to share with you this advanced trading strategy. So I want you to know them, so that when you get involved with such type of information, you should understand what exactly they are talking about. They're not talking about something over the moon, or something that you never know. At least it's something that you understand a little bit. Then you make a choice on your own. All right. So one of the when we talk about advanced trading strategies, we are talking about understanding the breakouts of the market, right? Understanding where the market is breakouts, and be able to use that breakout of the market and to trade. And now, so that means when you are spotting the breakout of the market and be able to trade on that breakout on the market, it's actually working on our advantage, right? So that the aim is to actually make a good profit for ourselves, make money, and enjoy ourselves. Okay, so the breakout, the breakout trading strategy, how it works is very easy. You can spot it as well on your own in a platform. You can be able to see it. One of the most popular trading strategies, the breakout, is the strategy of monitoring a currency pairs as it oscillates up and down in a narrow price range, right? So mostly the breakout, you cannot use the breakout strategy, especially when you're trading the indices. Because of when you're trading the indices, remember the index is a combination of over lots of company together and actually listed in a stock market. So what it means, the breaking out of that specific instrument is not going to work, because of there's different types of companies who are running, and they are actually making different types of money. Some they're making money, some they're losing money, some they're generating more income in their companies. So it makes the indices to be very, very predictable when you want to use the breakout trading strategies. That is why it is more recommended to trade breakout strategy only when you are trading the currency pairs. All right. Depressing a trade depending upon the direction of the break of the range. A long position can be pressed if there is a break above the range, or a short position can be pressed if a break below the range occurs. Buying or selling usually occur after the price makes a move out of the range. All right, so here's another key point here: out of the range. Why I'm saying that it's a key point, it actually tells us that buying or selling usually it can occur after the price makes a move out of that range is been forming. So all along the price has been forming the range, and then immediately when it stopped forming that particular range and start forming a different range, that's where it's called the breakout. Now it's breaking out from the one range that it was, whether it was a bearish range or bullish range or a sideways range, breaking up from that, trying to form a new range. That is where a buying or a selling can be mostly usually occur in that particular space. Another point here that we should take, a long position can be placed if there is a break above the range. So we need to understand the break above the range, right? That's where you can open a long position, right? A short position can be placed if a break below the range. Now this one, it's break below the range. So those are the actual key point that you can see in terms of the breakout. When can you buy? When can you sell? The key point there, it's break above the range. The another one is the break below the range. So if it break above the range, you know that definitely it's a long position trade. If it breaks below the range, you now know that it's a short position trade. Do we know between the long position and short position? It's the same as buying and the selling. So when you say we're going long, we are saying we are buying. We're going short, we are saying we are selling. So if you realize that you see the market, it goes with the range and then it breaks above that range. The range has been coming pretty nice, and then the market goes all the way down and breaks above that range. You must know you must take a long position. All right, we're gonna get in a chart so that we can see this thing by when we continue going with a presentation. So far, are we good?
Yes.
So far, so good. All right. So the point number one as well that you can take, it has a price remain in a narrow range for an extended period of time. The longer price remain flat on its as narrow range, the possibility of breakout increase. Here's another key point. The longer the price remaining flat, right? Take a note of that. The longer the price remaining at the same range, playing around at the same range, if it takes a little bit longer doing that, or in a narrow range where it goes up and goes down, but it's still, if you look at it, it's still in the same type of a position, that's where you should know that the possibility of the breakout is actually increasing. The more it's playing around at the same position, there will be a breakout. Now, people who trade breakouts, that's why we call it the advanced trading strategies. Those who trade the breakouts, they have understanding of the range. They know when the market is ranging. They know they have a patient enough to wait the market to be ranged until it's finished, and then use the breakout when it break out and start forming the candlestick of going to any direction and enter the position as a strategy. So most of the people who do that, they are actually not all the time in a market. They are watching the market, but they're not all the time, once they see the trade, they're jumping in. Once they see the trade, they're getting in. They actually want to analyze the trade, understand the ranging, and then wait the time where it's breaking out and enter in a market. Are we together this? All right, so far so good. What was the overall market direction or a trend before the narrow range? So often when the breakout occurs, the price continues in a direction of which it originated, right? Remember, when a breakout occurs, key point, the price continues in a direction where, in a direction of which it was originated. So once the breakout, it happened, it actually means the price wanna go to continue to where it was before. Now, here's where you understand the market now to say that, okay, if it get to the breakout, that means the price is going to the way it was before. What can I do now? I'm gonna now add a take profit from that range, or I'm gonna now put a stop loss from where I'm entering, so that once the price get to that, if it reverses, it touches your take profit, or if it goes to the price, original price where it was, it hit your take profit. So basically that's how you actually spot the breakout ranges in the market. So just few more seconds, let's see if we can identify any breakout range. Okay, so key number one, remember, we check the currency pairs. We don't check the indices. We look at the currency pairs mostly. So we go on the Euro USD. I'm gonna try to clean it up. This chart. All right. So as you've been listening to me since, when we talk about the time frame on a chart, we always say we must check the time frame on a bigger time frame. The bigger time frame enough that it can be able, to be able to check on it. I think a daily to 4 hour, it will be good enough for us to trade, of course, if we are the daily traders, So I'm looking at a daily trade, then I'm looking at a H4. If you look at it on a daily, the market, it tells you that it's been ranging at the same particular position. So I'm going to shade this position so that you can understand pretty much what we're talking about. All right. Okay. So pretty much the market has been playing around at these positions. Right? Let me see if I cannot change the color of it. Yellow, let's put, yeah. It's been playing around at the same position. Comes down, goes up, comes down, goes up, all the way. It's not breaking whether up or whether down, right? Now, the point it says on the range, the more the market is being ranging, the higher possibility of the breakout. In that case, it might range, goes up and goes down, and now start breaking up. Now, the point where you can take is that this is your the breakout points. This one and this one. Two breakout points that you have at that particular position. Now, what it says, when it break out below the range, it actually to say you must shorten the price. So if it break up below here, you see this side, if it comes all the way and breaks here and give us another candlestick that comes all the way here, it's an indication to say sell the position. So if you are doing the pending orders, and like what we were talking about last week, this is where you put your pending order as a sell. You say that, okay, all right, I'm waiting the market to break on this position. I'm going to move a little bit down to put my pending order. If it comes and break here, it will hit my pending order as a sell, and it triggers my pending order and start going with the pending order. Here's another point. It says if it breaks above the range, it actually means you are taking a long position. When you are taking a long position, they are saying you are taking a buy position. So if it breaks somewhere around here, it actually tells you that it's going to skyrocket and goes to the original price, if you understand what we're saying. To the original price. It means it breaks looking to the original price that it was. So here's a nice strategy, simple strategy, that you just look at the breakouts, but understanding where you should buy or when you should sell. So here you can put a buy pending order somewhere maybe above the red line that I just put, to say that if once it gets there, breaks the red line, hits your position, goes to the original position, which is 1.14,978. That's the highest of the original position that it can go. And you can put your take profit on that. Once you put in a take profit, that's a lot of pips, ladies and gentlemen, from this to 11,225 to 14,000. That's over 1,000 pips that you can make here, but because of the range. Simple strategy of the range. So we're at daily time frame. Let's move to 4-hour time frame. Okay, let me come back to daily and let me remove this one. Okay, let's go back to 4-hour. Again, the market, the currency pairs are very nice and easy, and they can tell you everything that is happening in the market. Again, the market is ranging, as we said, same position, right? Same position over and over again. Here is the highest original price here. Now from this side, from here, if you want to take it all the way to this side, to the lower side, to the lower of the trade, that's a lot of pips that you can accumulate out of it. A lot of pips that you can make out of from the highest to the lowest. Again, same strategy. If it breaks below, it's a sell. If it breaks above, it is a buy. Breaks below, sell. Breaks above, it is a buy. Any questions so far? So far, do we understand how can we trade the breakout? Hey, ladies and gentlemen, this is masterclass trading. This one, if you master this one, trust me, you'll be making money all the time. You'll be just looking at the ranges, wait for the breakout, trade the breakout. All right, let's move on. All right, the second strategy, it's called the channel trading strategy. The channel trading strategy. What is the buy value in the previous pay? Shaver, do you want to trade it? Let me see. Are you talking about this one or on a bigger time frame? Hey Shaver, are you talking about this H4 or on a daily time frame? Oh, okay, the purple highlighted one. All right. Chevelle, what we highlight here, we are actually highlighting the range. It means where the market is been playing around at the same position. So if you had, for example, to buy or sell at this position, right, you couldn't really make money out of it. It's because of the market has been playing, going up, come down, going up, come down, same type of position without giving you a bigger movement that you can make a bigger, bigger volume of the pips. So what we are saying is that instead of you trading in this type of ranging trade, what you do if you are a daily trader who trade every single day, a little bit long trades, open it in the morning, close it maybe a little bit later, is to actually try to spot the breakouts. Try to spot the breakouts so that you can take the whole, you can enjoy the whole value of your trade when you are trading. Now, how can we notice those breakouts? How can we spot those breakouts? There's a key for spotting the breakout. The key number one, if you want to sell, if the range breakouts below the price, this is the breakout price, this one, 1.08041. If it breakouts below this price, it means it's going on a sell. It's going short. If it breaks out above 1.11225, it means it's going long. Now, another rule it says of breakouts, if it's going long, it actually going to the original price that it was. So the key point again is that if it's going to original price, you need to understand to spot where it was. Where was original price? Which is we spotted here. The price was 1.14978. So if it's going to break out above this line, above the range, this is the range, above the range, it means it's going to the original price. Now, the advantage is that you can put a take profit to that original price so that when it goes to the original price, you can now take your profit out of that. I don't know, did you get me? Yeah, so pretty much you can make a lot of pips, but you can make over 1,000 pips, 100 pips, 200 pips. It depends with the where was original price it was. If the original price was really, really higher than this spot, you can make that 1,000 pips, right? And if you look at it from 1.11222 and 14,000, that's more than 1,000. That's more than 1,000 pips that you can make here. But remember, we are checking on a daily time frame. Now it actually means it's a little bit longer trade. From here to get here, it's not going to be the same day. So maybe it will take a couple of days or maybe a week or maybe 3-4 days to get to this level. Once you get to this level, you have collected over 1,000 pips. If you're trading with a standard lot, 2 standard lots, 5 standard lots, depending again how much money you have in your account to be able, to capitalize. Oh no, it's not Mr. Chavez. Remember, we are in a CFDs, contract of the difference, as I explained to you long ago. So we are on a CFDs, we are on a contract of a difference. We are not on stocks. We are not buying and selling stocks. We are trading the contract of a difference. All right, let's move on. And ladies and gentlemen, I have 8 minutes. It's gonna cut. Please rejoin again, as usual. So I was sharing with you another advanced trading strategy. Another advanced trading strategy that most of the people, they don't talk about these ones. These are channel trading. The channel trading is when the market is actually in a range, resistance and support price points within the range can often be identified. All right. Sometimes during the range bound, the market, these price points are reached in a succession. In this case, at a repeat resistance level, a trader can short the market in a trade feels that market will retrace down to the previous support level. And in a similar fashion, at a repeat support level, a trader can place a long position. It's important for a trade to do through analysis before execution the trade channel. So the trade channels, well, they're pretty much support and resistance, but trading based on support and resistance. Where support is going, you follow it. Where resistance is going, you follow it. Where support, like that. So you are trading the channel of the trade. So you can have two types of strategy: breakout strategy and a channel strategy. A channel strategy, you use it to actually trade scalping in a market. So you notice the range, but you understand that in this range, the market will come down, goes up, come down, goes up, ranging around until it breaks, then get to the position that you want. So you can use the channel trading, trade with the channel where it's channeling to. Going down, you trade with it. Goes up, you trade with it. Goes down, you trade with it. Then you have a long trade. That is waiting when it breaks. Immediately it breaks, you take your long trade, your long position, whether you're going short or you got longer to be able, to capitalize in more money. The continuation of the range may make a channel trading a favorable strategy. However, if the market breaks out the range, there is a possibility of the channel trade being placed in a wrong direction. That's where I'm saying, you trade the channel, but once it breaks, you must be out of the channel range. Because now it's no longer the channel now. It's no longer the channel range now. Now it's actually forming a trade because it has break and now it's forming a trade. So you must leave the channel tactics or channel strategy and now get the breakout strategy. Breakout, whether you buy or you sell, you keep on a trade. I hope you understand. We good? So far, so good. All right. All right. Okay. So another type of advanced trading strategy is called straddle trading. Straddle trading. Straddle trading, a trading strategy of setting entry stop orders above and below either a narrow range channel of a resistance and a support level. Once one order has been filled, the trade can remove the other order when they're considering a straddle trade. A trade should evaluate the following possible trading techniques: a narrow range channel. So the possible trading tactics that you're gonna spot on a straddle trading, it's a narrow range channel. An entry buy stop can be placed above an entry sell stop, can be placed below in the event when a price breakout of either the price of the channel, a resistance and a support. An entry support can be placed above a resistance, and an entry sell stop can be placed below the support in the event the market makes push beyond either the level. All right. I'm not sure if you understand me on this one, on a straddle trading. So pretty much straddle trading, it's actually also clarify what we've been talking about last week about the pending orders, right? Now we talk about the pending orders. Now it tells us where you can put the pending order. So the key point is to understand that in a market, when you see the range, you can be able to trade the range and be able to use your pending orders, whether it's a buy limit or the sell limit or a sell order, or whether it's just a pending order itself. So you can be able to see this range and say, I'm putting my order, my buy order at this position. Once the range it comes here, it will trigger my price and goes with with where my direction it's actually wanna go. So in as example that we were showing earlier on, this one. So it actually tells us that you can put a pending order at this position, somewhere around at this position. It makes sense because it's actually the lower of the previous highs. So once you put a buy order here, when it breaks, it actually triggers your order you got. Now, here's another point that you should take. Some people, they'll put a buy order and a sell limit at the same position. What it means is that if it goes all the way to buy, it will trigger the buy order. If it comes the price at this position and fail to break again, comes all the way down, it will trigger the sell limit. Two orders at one position. Straddle, that's a straddle trading. You're putting two orders at one position, but you understand that once it's going up, once it breaks to that position, it takes your order, goes with your order. But if you don't break to that position, it will take the sell order that you actually put as a sell order. I hope you understand at this point. Any questions so far? All right, so far so good. All right, ladies and gentlemen, we only have a minute. It's gonna cut, and please rejoin again so that we can finish up. It's a very short presentation that we can finish up now. We're gonna be talking about the Fibonacci retracement. I know people, they've been heard about the Fibonacci retracement. We're gonna be able maybe to jump in and talk about a little bit of Fibonacci retracement. And again, we're gonna have to show you where you can get